Susan and Kevin had $2 million saved at age 65. They were 3 weeks from retiring. They had already given notice and they had already booked their cruise. They walked into my office to do one last check before actually making the final decision. What we found in that meeting changed when they retired, how they retired, and what they're going to pay in taxes over the next 30 years. Unfortunately, most families don't have this conversation until it's too late. Susan is a recently retired anesthesiologist, and Kevin was a commercial pilot, age 67, about to age out of the cockpit. Between their 401ks, their IRAs, and a taxable brokerage account, they had about $2.4 million in invested assets, plus an $850,000 house fully paid off. By every standard most people use, they had won the game. But the picture that they were looking at, the picture their CPA was looking at, and the picture that their 401k advisor was looking at was missing something. It was something left alone was going to cost them somewhere between $300,000 and $500,000 in taxes that they didn't have to pay. I want to walk you through what we found that day, because if you're at or near $2 million in retirement assets, there's a very good chance the same thing is sitting in your plan right now. And here's what most retirees with $2 million don't see coming. That money has been growing in tax-deferred accounts for 30 or 40 years, 401ks, traditional IRAs. Every dollar that they have grows without being taxed. The IRS knows exactly where that money is, and they have a schedule. At 73, for these folks, required minimum distributions kick in. The IRS forces you to start pulling money out of those accounts, whether you need it or not. And every dollar that comes out is taxed as ordinary income. For Susan and Kevin, $2.4 million growing at 7% for the 8 years between 65 and 73 would be sitting closer to $4 million by the time RMDs hit it. Their first year required minimum distribution on that balance would be about $150,000. So stacked on top of Social Security, on top of pension income, on top of any other income they had, that pushes them into the 24% federal bracket, plus state, plus IRMA penalties for Medicare premiums, which spikes once your income crosses certain thresholds. The way I describe it to families is if your income stays roughly flat, but your taxes don't, the curve climbs every year until you're paying tens of thousands of dollars more in taxes than you ever did when you were working. You see, that's the trap, and it's invisible until you're already in it. My name is Chris McClure. I've been a financial advisor for 31 years, and I put these videos together about once a week. Hopefully, it's honest information for high net worth families who've worked too hard to leave money on the table. Real quick, if you're watching this and already wondering whether your own picture has the same shape, there's a link below where you can set up a call with me directly. There's no cost, no pressure, just a conversation. And there's a second piece to this that almost nobody talks about, and that is that on average, women outlive men by several years. When one spouse passes, the surviving spouse files taxes as single, not married filing jointly, but single. And the brackets for married couples versus single people are about half as wide. The standard deduction is roughly half as much. The Medicare thresholds I talked about earlier are actually lower. The same income, same Social Security, same RMDs, same pension gets taxed at a substantially higher rate. Gets taxed at a substantially higher rate the moment one spouse is gone. For Susan and Kevin, the projections show that if Kevin passed first at say 82, Susan's tax bill in the years following would climb by another $20,000 to $30,000 a year on the same income. You see, that's the widow's penalty. And most couples, they don't see it on the horizon until it's already happening, unfortunately. But there are two solutions that we can use. And here's what we actually did for Susan and Kevin. The two levers, the two solutions, they work on different time horizons, and most plans use neither of them on purpose. Lever one is Roth conversions during the planning window. You see, the years between when you stop working and when RMDs start are the lowest income years most retirees will ever have. For Susan and Kevin, that window was 65 to 73, 8 years. During those years, we converted a portion of their traditional IRAs to Roth IRAs every year. They paid the tax on the conversion at today's brackets, 12 and 22%, instead of the 24 and 32% brackets they'd be in later. Every dollar that we moved to the Roth grows tax-free for the rest of their lives. They don't ever have an RMD, never another tax bill, and also it doesn't count against Susan if Kevin passes first. They're also able to leave it for their kids and grandkids tax-free as well. For Susan and Kevin, the 8-year conversion plan projected to save them somewhere between $200,000 and $300,000 in lifetime taxes. The second lever is something called qualified charitable distributions. and you start those at age 70 and a half. You see, once you turn 70 and a half, you can send your money directly from your IRA to a charity. So if you have charitable intent, and let's say you give money to a church or you give money to a hospital or some kind of charitable event or charitable entity, this could really help. And you can do $100,000 a year per person. The dollars that go to charity, that way, they don't count as income. They don't count against your bracket. They don't trigger IRMA or Medicare taxes, and they don't count towards your RMD. Susan and Kevin had been planning to leave money to their church and to a children's hospital in Kevin's will anyways. So we restructured that giving to happen through their qualified charitable deductions during their retirement instead of through their estate after their deaths. Same charities, same total amount, but about $30,000 per year of tax that just disappeared. You see, both levers, they attack the same problem from different sides. The conversions reduce the trap, the QCDs work around what's left. And when we mapped out the full picture together, those bridge years, those years in between when they retire and when RMDs start, the conversions and the QCDs, the change was significant. Without the plan, Susan and Kevin were on track to pay somewhere around $1.1 million in taxes over the course of their retirement. With the plan, that number came down to roughly $700,000. So it's $400,000 that stayed in their portfolio. $400,000 that compounded for them and their kids instead of going to the IRS. And Susan mentioned after seeing all this that nobody has ever shown me this before. You know, I've been doing this for 31 years, and I hear that line a lot. It's not anger at the system. It's not surprise at the numbers. It's just nobody connected the pieces for me. And the reason that this trap exists isn't because anyone is doing anything wrong. It's because no one's looking at the entire picture. You got a 401k advisor managing the portfolio, CPAs filing the returns, a state attorney drafting documents. Everyone's doing their part, but no one's holding the whole picture together. And I have to admit, and I've said this on other videos, I'm a bit of a weirdo. I actually read tax returns and estate documents and investment statements, all on the same desk so I can see where they're working against each other. And the question I always ask people is, when was the last time your CPA and your attorney and your financial advisor actually met and talked about your situation? And for most families with $2 million, the answer is never. And that gap, like where we're talking about today, is where the tax trap quietly costs people hundreds of thousands of dollars over the rest of their lives. So if you're approaching 65, or maybe you're already there, and you've got $2 million or more in tax deferred accounts, here's what I tell you. Run the projection, not just on the portfolio alone, but on your whole picture. Look at your accounts, your future RMDs, your Social Security timing, your charitable intent, even your spouse's tax filing status once you're gone. It takes a few hours to build, but it takes most families 30 years to recover from not building it. And so Susan and Kevin walked out of that meeting with a different retirement than the one they walked in with. They still retired 3 weeks later. They're still on that cruise. But the next 30 years of their financial life, it looks fundamentally different than it would have. And if any of this is real sounding familiar, or if you're sitting on a portfolio you think is set and you've never actually seen a tax projection, that's exactly the kind of conversation I have with folks all the time. The link is below. I'd love to chat. Hopefully this is helpful. I really enjoy making these videos, and I'll see you on the next one.